All right, so good morning, everybody. This is Jan Kranen speaking. I'm leading the Research Policy Network on European Financial Architecture at CEPR. As you probably know, within CEPR, there are several such so-called RPNs devoted to different topics, and the one that you are in now is the European Financial Architecture, trying to understand how the financial system evolves in Europe and globally, and understanding how banks and markets interact and how new actors are coming in and out and how the dynamics of the system in response to regulation and vice versa is developing. And so we have today a webinar that is devoted to the topic of private credit, a topic on which Becker has worked a lot himself, and he has put together this very interesting panel of speakers. I'm very glad that we have this topic, which challenges banks and capital markets as the main competitors, if you wish, and to understand better how this works, I think is essential for all of us. So I'm glad and grateful to Bo to have organized this, and I hand over to Bo. Please, floor is yours.
Thank you very much. Thanks everybody for being here today. Thanks to the participants online. Thanks to the panelists. Let me talk about logistics quickly. We have an hour for this webinar. It is being recorded. We have a Q&A tool in Zoom, and we hope to have interaction. If you have a question, you can put it into the Q&A tool. We hope to circle back to that toward the later part of the webinar, and ideally, I would like to ask people who put a question into the Q&A tool to then, when I call on you, to turn on your microphone and read it out, or put it in your own words. If you don't like that, I can read it out for you. Just indicate that in your Q&A. So we have three. So let me first start by saying I think this is a fascinating development in credit markets, that more and more of the origination and funding of credit to corporations and perhaps households as well is moving out of traditional banks in various ways. And private credit is sort of the extreme version of this, where potentially banks are not involved at all, yet the end product to a corporate borrower is pretty similar in many ways. It's credit, it has covenants, and so on. So that's something that's been growing a lot, and we're going to talk about that. What are the implications? Who is this for? Who is affected? How? What's happening in the US, elsewhere? Will we see the same growth in Europe? And so to discuss this, we have three excellent panelists. Tobias Adrian is an economist at the IMF and knows a lot about the global outlook for this area and what's been happening, and will start us off by talking about his views. And then we have Nishan Srinivasan out of London at Ambienta Credit, operating in this sector, and Thelin of P Capital Partners in Stockholm, also active in this area. And so I look forward to a great discussion, and I would like to now invite Tobias to kick us off.
Thanks so much, Bo, and greetings from Washington, D.C. I'm going to start sharing my screen. I brought a couple of slides, and in order to sort of set the baseline for the discussion. So when you look at private credit over the past 20 years, you see a very rapid growth, particularly in the past decade. And so globally, according to our data, global private capital in private credit is about $2 trillion. Of course, relative to overall credit markets globally, this is still somewhat small. You can think of that as being perhaps 100 trillion or so. Global GDP is about 100 trillion, global credit is about 100 trillion, global market capitalization is about 100 trillion. So, 2 trillion is small, but it is growing very, very quickly, and it is reshaping the way that credit is done. You can see there's an outsized role here in the United States relative to the rest of the world, but that may change over time. So the two sort of related markets out there are high yield bonds on the one side and leverage loans on the other side. So leverage loans are tightly linked to banks, while high yield bonds are in market space. They have somewhat similar characteristics in terms of riskiness, but in terms of the plumbing of how these different forms of credit are originated and managed over the lifetime, they're very, very different. And I will dig deeper into that. So this is sort of like a big picture schematic comparing bank loans. So here you could think about bank loans that sit on one individual bank or broadly syndicated loans. And you all know broadly how banks work. Then there's market-based finance on the other hand. So those are the corporate bonds. And in the middle here is the private credit. And I'm just going to walk you through this schematic a little bit. It's somewhat involved. So really the corporates traditionally are small and medium-sized firms, some of which are fairly risky. So it's the risky middle market, and that was traditionally underserved by the banks. So there's an aspect of financial inclusion in private credit. So it is really developing a market and credit access to some corporations that traditionally had few lenders. Of course, that is starting to change as private credit is sort of like broadening out into the borrower types. And I think that could be an interesting issue for discussion. So what are those loans? Those tend to be floating rate loans with heavy covenants. So typically the firms, particularly the private equity firms that are ultimately operating the space, are heavily involved in the structuring, but also potentially the restructuring of those loans. And the private equity firms are involved typically through business development companies, BDCs, but sometimes also through CLOs, open-ended funds, or closed-end funds. So there are a number of different structures that are in the marketplace. And then the end investors typically are pension funds, insurance companies, or sovereign wealth funds. There's a small share that is starting to be marketed to retail. This is mainly sort of like high net worth private family offices, but there could certainly be some demand. And some recent evolution is to see more and more of bank leverage, bank credit being involved. So nowadays, the deals that are being issued typically get some leverage through bank credit, and banking regulators are starting to look more closely at the credit risk exposure of the banks relative to this sector. And I think, Viral Acharya and co-authors have done a recent paper on that aspect. Now, let me turn to the policy concerns from a broad financial stability perspective. We really have 5 concerns. I'm going to rush through those 5. There is a question about who are the borrowers, how are valuations done, how much leverage is there, how much liquidity is there, and what is the degree of interconnectedness with other financial institutions. So let's start with borrowers. So, it is an expansion of credit. So private credit expanded the types of borrowers to relatively risky borrowers. In that sense, it is financial inclusion, but of course, you always have to be careful with financial inclusion, whether there's sort of like excessive risk taking. So private credit is nowadays intensifying competition with the banks as private credit is sort of like broadening the borrowers. And a really important driver here is that the past returns and the past Sharpe ratios in that space have been tremendously good. So you basically have realized returns over the past 10 to 15 years that is above high yield credit, for example, but with a lower measured volatility. And so you see an enormous inflow of funding into private credit. So in particular, the left chart shows you the LBOs financed through broadly syndicated loans versus private credit, and you can see that private credit is sort of like starting to crowd out the traditional syndicated loan market. And we hear more and more from the banks that are saying, you know, there's a problem here. We just can't compete because we have all these regulatory constraints. Private credit firms are medium-sized, so the borrowers are medium-sized and relatively highly leveraged. You can see that on the right chart, where we sort of compare a typical investment-grade borrower to, say, a leveraged loan borrower or a private credit borrower. So very different characteristics traditionally, though, again, this is broadening out. Now, turning to the borrowers, you know, as interest rates have shot up, of course, leverage has jeopardized borrowers' ability to service their debt in some circumstances. So you can see, for example, the interest rate coverage ratio here. You know, debt to EBITDA, so leverage has stayed constant, but of course, with rising interest rates, interest rate coverage has dropped. And so I'm sure that other panelists are better placed to sort of explain how private equity firms or these business development companies are then working with the borrowers to sort of restructure terms. So payment in kind is a typical tool here, where, you know, borrowers that cannot meet their interest rate coverage get some restructuring, and that is sort of like hardwired in the way that the covenants are written, so that you know, the loan is basically extended. So there's sort of like a restructuring that is done in real time. Turning to valuations, you know, the accounting treatment is fair value accounting, you know, there is, of course, this concern to what degree you know, the accounting value is sort of like reflecting a true value of if this loan was traded. So this is illustrated on the left chart, where we compare you know, leveraged loan B and BB rated market pricing relative to the accounting based fair value. And you can see that the accounting fair values are sort of like less volatile, even though the credit might be more volatile. And so how much of that is that the market to market is different from actual trading versus, you know, this involvement of these private equity firms in addressing credit problems actively. I think there's some debate, but there's some sort of concern that, you know, price signals may not work in as timely a manner as, say, in high yield bond markets and so. Now, the middle chart shows you the discount to the net asset value in times of stress for the BDCs, and how much of that is explained by running a simple regression on the index of leveraged loans, and you can see there is a pretty high correlation. So perhaps it's not as much of a deal. And the right-hand chart shows you like an impulse response function of you know, how long it takes basically when there's an unexpected downward shock for, you know, price to net asset value to adjust. So, you know, staleness and accounting practices are a concern here. Now, turning to leverage, so the left chart really shows very clearly how leverage of these BDCs has evolved from about 0.5 to about 1. So, you know, it's a slow creep up, and of course, you know, relative to, say, leverage on banks, you know, this is very small, but still it is sort of like an exposure to the banking system because the leverage is generated via credit lines that go back to banks. So the system is somewhat complex and there's limited visibility into the system. So both for policymakers, but also for investors, right? So really understanding who has what exposure is somewhat difficult. You know, some firms are publishing a lot of detail on their lending book, but others don't. And so having sort of like an aggregate system-wide picture is somewhat challenging. Again, I'm sure Bo can complement here from a research perspective. Now, when you look at liquidity, you know, there are some mismatches. We think it's limited for the moment, but it is growing. So this in the chart here, the private credit with greater redemption rights. That's a small share, so you know, about 15% at this point of total credit, but it is growing. So certainly more liquidity transformation going on. But you know, the magnitudes are very different from, say, the shadow banking that we all remember from the pre-2008 run-up with subprime mortgages. Now, turning to interconnectedness, you know, there's a growing exposure of pension funds and insurance companies. So the left share, for example, shows you the left chart shows you the share of level 3 assets of leveraged pension funds. And, you know, particularly in North America, you can see so like a relatively high share here of these level 3 assets. Remember, the level 3 assets are the ones that are not marked to market or where there's no market price available. And that's, of course, the case for those private credit assets. And you can see the upward trend here. So this is plotting 2016 versus 2022. And for insurance companies, you have a similar picture. In fact, you can see that there's some pretty highly leveraged in insurance company in terms of the share of level 3 assets. Now, what are so like what is a downside risk scenario? And this is my final slide. So say there is sort of like a credit event, right? So we have never seen, so with this magnitude of private credit, we have never seen sort of like a downturn or recession. So say there was sort of like a credit event or global recession or so, there could be pressure to deploy capital. Competition with the banks could increase, underwriting standards could be lowered, and the vulnerability to the downturn could increase. So when the severe economic shock hits, there's a lack of transparency, and there could be a sudden spike of losses and defaults. Market participants may react in some way by curbing lending. Borrowing firms could draw on the revolvers, so exposing banks, and then the private credit funds could face liquidity pressures. Of course, they have lots of gates and protections, but on the margin, there could still be some liquidity pressures. You know, interconnectedness in between the banks through credit, the pension funds, and the insurance companies, you know, could magnify effects. The retail funds, which are small at the moment, could generate additional pressures. You know, private credit investors could be forced to sell assets in illiquid markets, and there could be a spillback into public markets, such as the corporate bond market or leveraged loan market. So our policy recommendations are primarily focusing on enhanced regulatory oversight. So, you know, the relevant supervisors, and it's a mix and match of different supervisors, right? This includes some market regulators, such as the SEC, some banking regulators, but also some insurance regulators. They certainly want to make sure that they understand what is sort of going on quantitatively and in terms of contractual features. Secondly, there is certainly a lack of data at the moment. So, you know, closing the data gaps, both for market participants, but also for regulators. So there's certainly room to enhance reporting. And then, you know, addressing any liquidity or conduct risks going forward. You know, I'm particularly worried about the fact that the performance has been very, very strong in the past. And so you could see like a lot of inflow into this credit class. And when you see massive amounts of inflow, there can be some very well-managed firms that do things right, but you could have other entrants that could be less well-managed, higher risk takers that are then like starting to muddy the waters. And so the asset class as a whole could be impacted by like inflow pressures. There could be more and more of a pressure to dilute underwriting standards, dilute contractual features, if you were to grow enormously. And, when you look at, say, surveys of insurance companies asking, what are your preferred asset classes, right? They typically rank, private credit above any other asset class in terms of expected returns going forward. And that, of course, is interpolating past returns, right? So, so like the dynamics going forward may trigger like quite a bit of change in this space relative to what we've seen in the past 10 years. So, things may look very good in the rearview mirror, but very different in the future. Let me stop here and pass back the ball.
Great. Thank you, Tobias. Maybe for some people not paying attention to what's happening in the US, we should say something about BDCs. So BDCs, correct me if I'm wrong, Tobias, they are permanent entities, meaning they have permanent equity, and they tend to complement that to some extent with credit from traditional banks. And then they give loans, and they have very long-term perspective. Theoretically, they could be a, relationship lender forever because they have this permanent capital. But in theory, they're sort of run-proof because they don't have any deposits, unlike a bank. And they're one channel through which funding shows up there in your figures, not the only channel. You said 300 billion, I think, out of 2 trillion. And one feature is that they have a US sort of specific tax situation, which means that they may not ever show up in Europe or Asia. Would you agree with that?
Yeah, so I'm not sure about the 300 million. So the 300 million that I showed is really the private credit funds with greater redemption rights.
Okay.
So, the total universe of BDCs is somewhat larger than that. I think, in the US, it's the majority of private credit is going through BDCs. So BDCs have different sort of governance structures relative to the private equity space or the banks. Some are independent, some are sort of like affiliated. There are many different arrangements. But yeah, they're the primary legal vehicle. But as I said at the beginning, there are also CLOs that are somewhat similar, but legally different and have different incentive features. And then there are also open and closed-ended funds. So these are all these intermediate layers that are basically sitting in between the corporates and the end investors, which are, say, pension funds and insurance companies. So there are different structures with different, legal features, different incentives that may ultimately have different implications down the line if there was a major credit event. Again, I'm sure that Nishan and others can shed more light on that particular aspect.
Great. Thank you so much, Tobias. Nishan, let me turn to you. So you're active, you're based in London, you're active in Europe, if I understand correctly, and you are head of Origination. So please tell us a little bit about what you do and how you see this market.
Super. Happy to do that. Hopefully you can hear me well. I'll introduce myself very quickly as well, because I think for a forum like this, hopefully I've got quite an interesting career experience. I've been in the world of finance almost 30 years now. I started in the mid-90s. So obviously I've seen quite some cycles, the dot-com boom and bust, the great financial crisis, and more recent ones as well. I spent most of my career in investment banking. So at Credit Suisse, I ran leverage finance origination. So I've seen that side of banking in terms of actually banks doing what they used to do 30 years ago, which is lend to companies, and also arranging syndicated finance, the leverage loans and high yield bonds, which Tobias talked about. I also looked after the investment grade business at Credit Suisse. So I saw with the IG business, which we didn't touch on so much, Tobias, but is obviously the largest part of the market. And then about 2 years ago, before Credit Suisse went bust, actually, so I had some insight into when banks go bust also, which was interesting. But then I moved into Ambienta. We're a mid-market private asset manager focused on sustainable strategies, so environmental sustainability, and we're classic private credit. So what we have is a 7-year fund. So we have long-term money from insurers and pension companies. So our largest investor is APG, second largest pension company in the world. We've got some Scandinavian pension funds. And these funds have put 7-year money with us for us to make loans to mid-market corporates in Europe. So this long-term money we're matching with long-term liabilities, for want of a better way, long-term investors, and we'll see to make a return. Typically, like us, all private credit, most private credit shops in this kind of guise are targeting returns in the high single digits, low double digits. So Tobias, you mentioned that it's quite a popular asset class. I think the reason it is popular is because if people can believe that private credit managers can generate, call it, high single digit returns, risk adjusted, that should be quite a nice place and nice inflation protection for investors. And think, most of our investors are pension funds, so they're trying to protect their pension pots for their pensioners. I think the final point, I don't want to talk too long. We can get into debate a bit more, but the final point I would want to make is that the market in Europe and the market in the US are quite different. And Tobias touched on some of these points. BDCs don't exist in Europe. Some of the very largest asset managers, think Blackstone or Apollo, have BDCs which can invest a little bit in Europe, but the majority is US. Secondly, we don't have backing from wholly owned insurance companies. So the very largest asset managers, Apollo is the obvious example, which everyone's read about in the newspaper. A lot of their capital comes from an insurance company they wholly own. We don't have that phenomenon in Europe. And then the third thing, which is a point of differentiation, is that, and I'd love Anders' point of view on this as well, but 99%, in my experience, of European LPs, European pension funds, insurance companies, don't like leverage. So our fund is unleveraged. So that interlinkage into banks, which is clearly something that Tobias should be focused on. We can debate how meaningful of a risk factor it is, but it is a risk factor, is much more mitigated in Europe because most funds that I speak to and our fund is not leveraged. So if we lose money, long-term it's pension funds and pensioners which will be impacted, which is not a great outcome, clearly, but it won't have systemic risks to the banking system, for example. Why don't I pause there, because I do want to let others speak as well.
Let me just ask you one quick follow-up. Say something about your geography or industry focus. Who do you lend to?
Yeah, absolutely. So we lend, which is an interesting point. We lend to European, we're focused on pan-Europe. So we can lend up in Scandinavia. We do deals, our heartland is Germany, France, UK, you name it. We lend to mid-market companies. So companies with an EBITDA from anywhere from 5 to 30 million, call it. which actually is very interesting because regulation has pushed commercial banks away from lending to those kinds of investors. And the syndicated market, the high yield bond market, tend to prefer larger deals, because what we've seen in the last 2 years in particular is a ton of volatility in the public markets. And so if you're a money manager for BlackRock, you'd rather invest in, Sanofi's pharma business, which is about to be sold to CD&R because it's a big company, rather than a company with 20 million of EBITDA. That, frankly, and I'm sure Anders will agree with me, that's what private credit was invented for, because we can do private style due diligence with long-term backing from our pension fund investors to lend to these small companies that banks have regulated themselves out of, and large, BlackRock type managers, and I'm not denigrating BlackRock, great firm, largest asset manager in the world, but they don't have time for, frankly. So I think that hopefully that answers your question. Final point I'll make before I shut up is we have an environmental focus. So we will back only what we call environmental companies which are, driving the change that we believe, hopefully all of us will believe, will be necessary, as the world slowly runs out of resources. The reason that's relevant for private credit is because, as opposed to a market which is buying, 1% of a deal, it's very difficult if you're an investor buying 1% of a deal to drive change in a company. Whereas if you're a private lender lending the entire capital stack to a company, you can say, look, I want to back you, but I'm really keen on backing companies that are building new factories or driving this change. And that's a force for good, which our investors, our pension funds, want us to undertake. So it's partly about returns, but it's partly also about, making sure that structures make sense for them and so forth.
Great. Thank you so much, Nishan. And Anders, let me now turn to you. So P Capital Partners is sort of the inventor, in my opinion, of this category in the Swedish context. And you have a long history with credit before it was popular. But now you're part of this bigger trend, I guess. And so please tell us a little bit about what you do as the head of the credit committee and what P Capital Partners does, and maybe compare a little bit to what Nishan said about Ambienta.
Thank you very much, Bo, for that introduction, and thanks for having me on this panel tonight. So together with a few colleagues, I started P Capital some 20 years ago on the back of a perception that there was a void in the financial market for medium-sized companies to find funding, which was not equity at that time. And just as Nishan said, and I absolutely agree with that, this tends to be and has always been an area which is underserved by the banking system. So we started off in the Nordics, and we still do the bulk of our business here. And if there's one thing that is universally recognized about the financial markets in the Nordics, is that our banking system has stayed in good shape for 20 years. So I think it's a testimony to the asset class and perhaps to our business that we have been able to thrive and give good returns in a market where the banking system have not had the type of problems where we've seen elsewhere, for example, in Switzerland. And we've focused on private debt, but we've done it slightly differently towards the main competitors or colleagues in the business. So today what we see is that about 90% of European private credit is tilted towards sponsor-owned business. So it tends to be private equity companies that are the biggest customers. We, on the other hand, do 70% of our business with family-owned business, other privately held businesses outside of the sponsor system. Also, in terms of geography, the two biggest markets in Europe today is obviously the UK and France, where we do actually very little. Those two markets tend to be around 60%, depending on how you measure. And for us, it's below 10%. And what we do is essentially provide funding to companies during a limited period of time Typically, it's around 3 to 4 years. And on the sponsored side, actually, it can be much shorter than that. I think the average period where private credit is involved can go down towards 1 year in certain parts of the cycle. And also that I think it's important to say that we are a closed-end fund, just like Nishan. And for us, that's hugely important, because being a closed-end fund without leverage, the systemic risk in what we do, and in fact, the risk to our investors with what we do is very, very small if it exists at all. Whereas it's always important for us to keep an eye on what's happening in the US, because in the financial industry, like in many other industries, the US tends to lead other parts of the world. So just like in movies, I think it's important to see what will happen here. And Wall Street has always been creative in terms of finding ways, if you like, to repackage the same ultimate product. And I think that's very important for the discussion we're about to have today, that the ultimate product is hugely liquid. We fund companies, they have the right to keep our money for up to 5, 6, 7 years. They don't always use that right, but that is the ultimate risk. And by claiming that you have a product that's liquid, that can be sold and turned over to another holder in days or weeks, it's a risk, because it can work in certain parts of the cycle, but for sure it doesn't work throughout the cycle. And we've seen that in the high-yield bond market. We do see it in terms of CLOs, and perhaps also in open-ended funds towards credit. I think we do, but not in the closed-end space. And I think also one important part about that is that the regulators in Europe were out quite early in terms of regulating this. So we are an alternative investment fund manager, and we need to be that to be able to function in Europe, because that's one of the prerequisites to be a credit fund. And by doing that, we are also supervised, which I think is a good thing, but we'll come back to that later today. So with that as an introduction, I'll turn back to Bo.
Great. Thank you. Let me have a quick follow-up there on the last point. So you're regulated, but do you have capital requirements? No, you do.
No, because again, capital requirements means you need to have debt to be able to have capital requirements. And,
Right.
and since we don't have leverage, our capital requirements, depending on how you measure it, is not the same relevance as for a bank, where again, 5% of the total capital is perhaps equity, and the rest is one way or another borrowed capital. So for banks, I think it's hugely important. For private credit, not that much.
Yeah.
Could I just add one point to that, though, please?
Yeah.
I don't want to interject too much, but I think there's an important point here, and just to step back, I'm not here to tell you that private credit or any other asset class doesn't entail risk. Clearly, everything we do entails risk. But it is important to know, in addition to the regulation that Anders mentioned, our investors, and I'm sure it's the same with PCAP, are long-term, very large regulated institutions. So that means, when a pension fund comes to do due diligence on you, to say it's painstaking is an understatement. We spend hours, days, weeks with due diligence. And actually, there's been a change in the last 2-3 years as the markets have seen a downturn. And obviously, you read in the newspaper about private asset managers being under pressure, in that for a new entrant to enter the market is extremely difficult now. We're lucky as Ambienta in that we launched 2 years ago, but our asset manager has been around 20 years. And I'll tell you why it's difficult. Because the manager's first hurdle is, okay, Nishan, who are you? What's your track record? Are you any good at what you do? And they will diligence that. They will have, reference checks on me. They will look at all my previous deals. But away from that, they'll say, okay, Ambienta, what's your compliance function? What's your legal function? What's your accounting function? Tell me about your risk function. And so if you're a brand, if you're just a guy, if I was Nishan Srinivasan, I wanted to set up Nishan Srinivasan Inc., I couldn't do that today, is the reality. Because you'd need to hire, we have 30 people in our back office working on all these things, and it's demanded by our investors. So that's a degree of, I don't know if regulation is the right word, but a degree of diligence, which I think is very healthy for the market.
Yeah. But maybe also partially explains why some of the entry is sort of from the side, from private equity shops who expand into credit rather than starting credit from scratch. Great. So we have a few minutes before I want to start opening for questions. Maybe Jan, go ahead. Yeah.
Just one observation from what I heard. So the market in the US and in Europe is very different then. Is that right? So that so in the US you have the banks being involved, providing the leverage. So you have this interlinkage between that market and the banking industry, which is always what academics focus on when they talk about systemic risk of that sector. While in Europe this is absent. Is that correct?
It's still absent, and I think it's just as Nishan said, it's very rare to see leverage because our LP base don't want it. And that's something I haven't seen changing over the years. But secondly, I think that European banks are reluctant to provide any sort of leverage to our type of businesses. Maybe because they, to some extent, perceive us as competition, but also because they see that it's a very hard asset to quantify the underlying credit risk. And European banks, they need to quantify a risk to be able to take it. I mean, that's one of the parts of the Basel II and now Basel III regiments. If you cannot fit it into your model, you won't do it as a bank. And clearly, private credit up until today doesn't really fit into the models.
Nishan, would you say the same? Would you agree? I mean, from the UK perspective, then, because this is more the Nordic countries' perspective.
Sorry, I was trying to come off mute. I do agree. I mean, I think what I would say is there is a bit of a bifurcation between the mid-market. So think of deals below 300 million in size, which, as Anders rightly said, have generally been underserved by commercial banks and are generally served by European private credit managers, versus the larger deals, which is the larger deals have become somewhat of a global business. And so, you know, if you're doing a deal of $1 billion, you're more likely than not to see Ares or Blackstone leading that deal. They're obviously global asset managers. They're headquartered in the US, but I think they call themselves global, and they often do benefit from leverage, for example. So there is a little bit of a conflation between the two. The other point it's worth making is clearly there is quite some innovation in the market as well. Private credit, I think, has seen a lot of maturation as an asset class now. So clearly, you know, to the extent mistakes were made, they were made a decade ago. But now we're seeing new asset classes adjacent to private credit coming up, and maybe they will make their own mistakes. And I'm sure Tobias is highly focused on, you know, regulating some of these adjacencies as they come up.
Okay, if I can just make one observation, Bo, if that is allow me. This is I find this quite strange what you are reporting about this larger market, because the role of the banks as refinanciers is, in a way, they give away their usual alleged advantage of having information, doing the due diligence, doing the monitoring to others, while they keep the funding side where they are not good at, really. This is what actually markets could also do. So that's a bit astonishing for me to put into my theoretical picture, but thank you for.
I mean, one answer to that, an academic view of what's happening here, is that there's the regulation that I think we talked about several times now of banks, right? And if you don't have short-term credit or short-term debt, you're not regulated that way with capital requirements and so on. And the other one is this global growth of long-term capital, which has also fueled, you know, other kinds of, you know, private investing like private equity and venture capital. And these trends seem to coincide a little bit here. Yeah. That's part of the drivers, maybe, you know, the insurance companies, the pension funds who want to put their money somewhere. So in a way, maybe in 1950, the deposit franchise of the banks was even more unique. In today's financial system, maybe less. Does that maybe? I wanted to ask about revolvers. Nishan and Anders and maybe Tobias as well. You know, companies need credit facilities or working capital financing, and they want to draw down, use sometimes, maybe not use. Can you provide it? If you don't provide it, how does that work? There's still a bank somewhere in the picture, or can you say something about this?
So, I mean, one of the reasons we started this all a long time ago was that we recognized that banks don't always want to fund the long-term capital for their customers. Because of regulation, because of capital requirements, they are careful with the balance sheet. And they do want to keep the customers, all the ancillary business of those customers, which is in part the flows, the daily flows of operations. And for that purpose, the RCFs is actually very useful. So the banks want to have those in order to keep track of the other business. And for us, that means that technically it's hard for us to provide an RCF because we don't have the systems to do it. And also, I think that in all fairness for the company, to pay Nishan's or my type of return on RCF money is not ideal for them. So a proper RCF, which for example has clean downs, so it's not part of the long-term capital for a fund, for a company, yes, that's better provided by the banks. And ideally then we work with the same security package, we work with the same risks. And I'd like to say that I'm in control, but the bank has the first right to their money back, and they are super senior in the same facility. That's, you know, the way it normally works, but there are exceptions, of course.
And I think to state the obvious, there's a very important role for banks in the entire system of financing corporates. They, you know, Anders alluded to this, they provide ancillary service that no other individual or corporation in the world can provide: transactional banking, FX, so forth. And so there is a role. What we've seen post GFC and post the EU funding crisis in 2012 or so is the regulators, the way this has expressed itself, I find, in banking in Europe, is regulators are saying, rather than previously you lending 100 million or 150 million to a bank which is quite to a company which is quite small, which obviously is quite a lot of exposure. If there's a default, your hold levels have to come down. That is the reason private credit has grown, and to effectively allow banks to hold smaller amounts through the revolver, so they can still have credit, provide the transactional services, but the bulk of the funded debt goes elsewhere. So it's effectively a democratization of risk in a scenario where you see multiple defaults. You know, clearly that was a learning from the GFC.
Great. Time is moving ahead quite fast, so I would like to open up for questions. I have many more things I want to ask, but I would like to see if Richard Portes would like to share your question about supervision. Are you there, Richard?
I am. Are you hearing me?
Yeah, go ahead, please.
Fine. Okay. No, it was a straightforward question specifically to Tobias about the role of regulators. You talked about needing a more intrusive approach from the micro-pru regulators. Is there any role here for the macro-pru authorities? What should they be doing in this space?
Yeah, hi Richard, good to see you. Thanks so much. It's a little bit difficult to give a straight answer for the reason that you know, many of the entities that are you know, at risk here are either not don't have sort of typical prudential regulation, right? So BDCs are oftentimes registered in some way with the Security and Exchange Commission in the US. Let me talk about the US first, because this is the biggest market, right? So typically the private equity firms and the BDCs are registered, and so say the SEC is collecting some data. So this is called the Form PF, the Private Fund Form, that you know, covers hedge funds and private equity funds, and also has some degree of information about private credit. But it's, very little of that is made public. And it is really just data, not a regulation. Now, to the extent that products are sold to retail investors, of course, micro prudential security market regulation applies. But many of the products go to institutional investors such as pension funds and insurance companies. Now, insurance companies in the US are regulated at the state level, and there is a prudential framework. But there's not really macroprudential framework around insurance companies, and pension funds do not really have prudential regulation. There's some state regulation, but it really depends. So again, in the US, you don't have like a broad macro overlay on these issues. Now, once we go to Europe, it may be somewhat different, though. Now the BDCs are playing less of a role. I think there is some degree of micro supervision of the sort of firms that Nishan and Anders are representing. But I don't believe that there's a broad macro approach here either. Now, could you or should you get to a macro approach? I think the first step is just to have better data on what the interconnections are, what the aggregates are. I think, when we did the work that I was presenting, we sort of used a lot of commercial data that is adding up to a fairly comprehensive picture, but it doesn't always give you the right insight into interconnectedness or leverage or liquidity transformation, right? So I do think there's some scope for more comprehensive data, but what kind of prudential tools are needed, I think, is still work in progress. The banking regulators certainly are starting to look at this, the exposure through credit lines, and they may take a more system-wide approach, but it is work in progress at the moment. So in principle, it's always the right approach to take a macroprudential and system-wide approach, but we simply don't have the data at the moment to fully do that. I'm gonna stop here.
Great. We need more data for sure. Anders, you wanted to reflect on this?
No, I think it's just worth saying that here in Europe, the European Commission has through the AFM2 regulations, which are now being rolled out, clearly shown that they want to look at this, and they've already introduced some limitations in terms of how a lending fund can operate, for example, in terms of liquidity transformation, but also in terms of using leverage. So I think the problem is recognized, and I think it's wise to look at it early, because Europe is still quite in a growth phase of private credit, and I think that there is a danger, a risk, of course, that the ones who move the quickest also somehow take risks that the regulators need to be aware of, because they are ultimately left with the lender of last resort role here.
Great. Tobias Berg has a related question to this. Are you there, Tobias? Would you like to share it with us on audio?
Can you guys hear me?
Yep. Go ahead, please.
Thanks, first of all. Very interesting presentations and discussions. I have one question on the regulatory landscape. Anders, Nishan, if you would need to name the #1 regulation and #1 regulator that is burdensome and costly for you, which one would it be and why?
Well, I think that, we are only regulated by one big regulator, that's the Swedish financial authorities. However, I think that the regulations in terms of anti-money laundering as for anybody in the financial industry, is cumbersome. It takes a long time. It needs to be done and be done properly. But I think if the one I would mention that I would want the regulators to, if you like, streamline, creating ways for low-risk participants to not cut corners, but be able to streamline the process. That would be welcome.
Perhaps to add to that, it's an interesting question, Tobias, because the regulation in the private assets business tends to be conduct related. So our primary regulator is the FCA because we're based in the UK, and then our local central bank because our AFIM is in the EU. That tends to be more around conduct. Things like, are you fit and proper to operate? Are you ensuring that you know your client well, anti-money laundering, all of these things. I'd say the expense to our business and the real work comes not from regulation, but from due diligence from our stakeholders. And that is not regulated per se, but what I can tell you is in the market in Europe, at least, in the market in which we operate, if you want to raise money, you need to go through that because these people demand it, and rightly so. They're protecting pensions after all. So I'd love others' point of view because it's a little bit of a case of market forces driving, the diligence we need to do to deliver on. And I'm sure Tobias would say you can't leave market forces unchecked, but these are, very large, austere pension funds and insurance companies typically we're dealing with. And so, all I can tell you is the amount of work and expense that requires from us is quite high.
Yeah, if you don't mind, Bo, if I can jump in on that. So I fully concur with that, right? Pension funds, insurance companies tend to be, very conservative institutions doing a huge amount of due diligence. Worry is that there may be some players that are not quite that conservative, right? Or they may be emerging, and it's useful to go back 20 years, right? And Nishan, you mentioned that you were working in banking at that time, right? And structuring was very much about tranching risk and selling it to different players. And some of the institutional investors had an outsized risk appetite, to put it mildly. And I concur that we probably don't see that today, but it's sort of difficult to rule out that we wouldn't see that going forward, right? That some large institutional investors are like shift their risk appetite, and that could potentially sort of change market dynamics more broadly. And I think the concern is that looking at the past returns, you see this tremendous performance, and that sort of like opens up the potential for less conservatively institutions to have an outsized impact. And that may not be the baseline, but it's certainly something we worry about. And regulatory safeguards are pretty limited at this point to contain such a dynamic if it was to take place. So I'm not saying that it has taken place, but it's a worry that it could, and we have few tools to contain these kind of risks. I don't know, Nishan, whether that's
I'll quickly respond because I see Jan Peter wants to get in as well. But let me give a 10-second response, and then I'll be quiet. You raise a really interesting question, and there's no panacea because the reality is you can never. It's very difficult to protect yourself from someone being stupid. And not all of us, sadly, are guilty sometimes of a herd instinct. which has been seen in markets, and we've seen many bubbles over the years. However, it is in my own judgment, there is a bit of an agency problem. So if you think about the financial crisis, the reason we had a bit of a problem is that banks in the US had moved from the the warehousing market to the I forget the phrase they used, but they had gone from in the 50s and 60s holding debt on their balance sheet, which means if something goes wrong, it's their problem, to the selling business where you clip a fee, and ultimately if a company goes bust, it's not great for your reputation, but you don't lose money. Contrast that with private credit, where our compensation, I don't know about Pika, but my compensation schemes are explicitly set on the returns we make. So if I make bad decisions, that impacts my compensation, and it also impacts where the pension funds want to invest with me going forward. And that is the ultimate risk alignment in my own judgment. It can't protect anyone from doing stupid things because that but I think that is somewhat of a protection in my mind. And I think if I might add to that, and then I'll be quiet, the other issue that we've seen is in the broader market. You mentioned the high yield bond market. High yield bond market's got a wonderful place. I was in there for 30 years, so I love that market. But what I'll tell you is two things. High yield asset managers live off the fee they charge, not the returns they make. And secondly, it's typically fast money. So guess what? When you read bad news headlines, a doctor or a dentist pulls this high yield money and puts it in cash. And that's the worst point because you're a forced seller at that point. Whereas for us, one of the only reason, not the only reason, but one of the key top of my list requirements when I decided to set up this private credit fund was I need 7-year money. Because if I'm going to make long-term decisions, I don't want someone pulling my money and me having to make, bad short-term decisions on the back of it. Sorry, Jan Peter, I spoke a lot. I should
That's great. Thank you. Jan, will you finish us off?
If I just can add one question or one observation is, I was always thinking that we have all this regulation in place because there is some public policy interest in it, which is either consumer protection or some implicit government guarantee and some systemic risk that's the only two arguments I know understand why we should have regulation. And I take from this session now that in the US there is a public policy concern because you have this leveraging. You have banks really being involved and also being hit if there's going something wrong. And banks themselves are systemic to some extent. But in Europe, I don't see that. Right? Neither consumers in terms of smallholders, nor any public policy interest. So my simple, more theory-based take is there is no reason for having a regulatory supervision in the first place.
Let's keep an eye on it, and I'm sure Tobias will let us know if the IMF spots an issue here that we're not aware of. We're a little bit over time. Thank you, everybody, for participating today, especially the panelists, CPR for hosting this, Tobias and Richard for asking great questions, and everybody for being here. And thank you.